Imagine you need money tomorrow, not next year, not next month, tomorrow. How quickly could you turn your investments into cash? That question is all about liquidity. Liquidity is simply the ease and speed with which an asset can be converted into cash. The easier it is to sell, the more liquid it is. The harder it is to sell, the less liquid it is. Cash is the most liquid asset. You can spend it immediately. Money in a bank account is usually highly liquid too. You can access it quickly whenever you need it. But not all assets are equally liquid. Some can be sold within seconds, others can take months, and some may not sell at all at the price you want. Let's look at some examples. Shares in large companies can usually be sold quickly. ETFs are often highly liquid. Government bonds are generally liquid. These assets have large numbers of buyers and sellers every day. Now compare that with a house. A house might be worth hundreds of thousands of dollars, but it can take weeks or months to sell. You may need advertising, open homes, negotiations, legal paperwork, and a willing buyer. The same can apply to businesses, collectibles, rare coins, fine art, or specialized equipment. They may have value, but finding a buyer can take time. Liquidity becomes especially important during financial stress. When markets are rising, liquidity often seems plentiful. Buyers are everywhere. Confidence is high. Transactions happen quickly. But when markets fall, liquidity can disappear. Suddenly there are more sellers than buyers. People rush for the exit at the same time, and prices can fall sharply. This is why investors often say assets are only worth what someone is willing to pay. At the moment, you want to sell, not what you think they're worth, not what you paid, not what an expert estimated, only what a buyer will pay today. This creates an important risk. You may own valuable assets, but if you need cash urgently, you might be forced to sell at a discount simply because there aren't enough buyers. That's one reason many investors keep cash reserves, not because cash earns the highest return, but because cash provides liquidity. It gives you options. Liquidity also creates opportunities. When markets fall and others are forced to sell, investors with available cash can buy quality assets at lower prices. Sometimes the biggest opportunities appear when liquidity is scarce. Liquidity doesn't just apply to individual assets. It affects entire financial markets, stocks, bonds, property, commodities, and even cryptocurrencies. When money flows into markets, prices often rise. When money flows out, prices often fall. That's why experienced investors pay attention to liquidity, not just asset prices, because liquidity influences how easy it is to buy, how easy it is to sell, and sometimes how much risk you're really taking. Remember, an asset can be valuable and still be illiquid. Understanding liquidity helps you manage risk, prepare for emergencies, and make better investment decisions. Because sometimes the most important question isn't what is this asset worth? It's how quickly could I sell it? This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.